So this is the review session for exam number 2, October 24th. So let me begin by just providing some overview of the material since the last exam and what will be covered on the exam in terms of chapter content. So this is, oops, hang on, that would help. So exam 2, review. All right, so it's which chapters? Little quiz to start with.
4, 5, and 7.
4, 5, and 7. So if this was Sesame Street, I'd say which one of these was not like the other? I actually do mean that.
7.
The 7. The 7's different than 4 and 5. So that's the first thing. All right. So 4 and 5 have to do with what?
Savings and investment.
Which is what? Has to do with what? That's correct.
The labor market.
Brittany.
No.
Is it goods market?
There you go. The goods market. Right?
I thought we were looking at all three. The production function, the goods market, and the labor market.
Well, we can, but right now our focus is on 4 and 5. So it's really on the goods. Chapter 4 and 5 are on the goods market. Now we can relate it back to that though. So in your questions, we'll get to that a bit later. Okay. I suspect you'll ask me something related to that. That it is. So we want to try and think about how it's related to. Well, I'll try and weave that in here. All right. So, but I don't want to muddy the water either. All right. It's about the goods market. So what's the difference between chapters 4 and 5? Because they're both about the goods market. What's the difference? Now I have you concerned.
5 talks about the open and closed economy versus 4 talks about the factors of savings and investment. Savings and investments.
Saving and investment in both. No S on the end of that. No S on the end of that. Investment. It's a verb. It's not stocks and bonds. It's machines and buildings and houses and software and nothing to do. Well, it's not the financial market. It's not investment the way you think about it in terms of the stock market. It's not that. It's about capital. It's about chapter 2, measurement of the economy. It's about investment in new capital. So chapter 4, so let's go back to 5, right? What Faith was just talking about. So 5, right, is about the I just got dinged again, so I just want to make sure everybody's in. Okay. So chapter 5 is about the open economy. What does that mean? So we'll get to some very specific things, but it's really actually really useful if you can put things. You should be able to do this kind of high level sort of outlining of. That's the first place to start, I would argue. I mean, you want to do it each chapter, but then we have multiple chapters together. Then you want to be able to do this kind of higher level outline of like what are the big ideas here and how is this all done? All right. So what do we mean by open economy? Versus what? Chapter 4, what kind of economy is it?
Closed.
It's a closed economy. So at one level, you need to understand that, right? Because if I ask you to compare what happens in a closed and open economy, you got to know what that means. And that's fundamental, actually. It's fundamental to these two chapters. What does a closed economy mean? Just in words. What does an open economy mean? We'll start there.
Isn't a closed economy is like doesn't do trades with outside of the country.
Right. No trade. Just looking at if we're just looking at one country, so let's say the US, right? If we were another country, we could use, if we were in Germany, it would say Germany only, whatever, but US only, right? There's no trade. What does that mean? That means there's no exports, no imports. If there are no imports and no exports, what does that mean? What's the current account? What does it imply about the current account? What is the current account?
Isn't that savings minus investments?
It is. That is correct. That is correct. And we can do it. Okay. I see that the live translation. Okay, I am enabling. All right. So you should, I think, see closed captioning going on. Yes, I see it myself. All right. So that's true. So on one level, back from chapter 2, that's good. So we know how did you get that? How do you know that? How do you know that? That's true. It's a true statement.
You said, how did I know that?
Mm-hmm. Mm-hmm.
To be honest, just reading.
Okay.
Um,
So remember back to chapter 2. Remember we said everything is cumulative in this class. And along the way, I've always said, whatever, things that we learn early on in the course, including from chapter 1 on, we're going to see later. You're going to see things from chapter 1 and chapter 9 again, for example. You see stuff from chapter 2 all throughout the semester. So the one thing that we've seen a number of times, right, is the uses of saving identity. Okay, this is good. We got a lot of people here tonight. It's good. So the uses of saving identity. What's that? What is that identity? What is it? Savings in it, obviously, right? Right, the word there, right? We saw it in the last exam. Saw it in homework 5. You can see it in homework. We're gonna see it on the exam. You will. I'll tell you that now. Shouldn't be a surprise. I'll give it to you though. Right? Private saving plus government saving equals investment plus the current account. Or national saving equals I plus the current account. Right? So if we bring I to the other side, we subtract I off of both sides. It's S minus I equals CA, which is what you just told me, right? That's where it comes from. Back from chapter 2, right? So the current account is the difference between, at any real interest rate, the difference between saving and investment in a country. Right? We also know that it's minus the financial account. We can come back to that later if you want. So in a closed economy, what's true about the current account? If there are no, so the current account is also right, net is also net exports, right? Whoops, not next exports, net exports. It's really net exports plus net factor payments, but we assume that net factor payments are zero. They're not a big part of this, so we can just safely assume like, okay, we're going to ignore that to keep it simple. So what do we mean by net exports? Well, exports are in there, right? What does net exports mean then?
The total amount of trade.
Not the total, that would be adding up imports and exports, right? Total amount of trade both ways. So it's exports minus imports. So if there aren't any exports and there aren't any imports, no, I'm just going back to what you told me, right? No trade, just one country, no exports, no imports, then what are net exports going to be?
Zero.
Zero, right?
So
Exports are zero, imports are zero, zero minus zero, zero. So the current account is
zero.
zero. The current account is zero. What's true about saving and investment in the closed economy?
Current account is zero.
Current account zero, that's here, all right? So what's true about saving and investment?
Zero.
Well, the difference is, what's true about the relationship? What's true with saving and investment? They have to be equal, right? Right?
Yes.
If this is zero and this is 100, then this has got to be 100. If this is 20, then this has got to be 20, right? If that's zero,
Yes.
saving equals investment, right? So in the closed economy, right? No trade, saving equals investment, right? But we know that. That's chapter 4. That's the graph from chapter 4, right? This is all going, hopefully you're gonna say, aha, this is all going somewhere. This is sort of random, right? A moment here. That, right? We go to the place where the lines cross, right? So this is desired saving. This is desired investment, right? That's what the curves look like. Equilibrium happens where what? Saving equals investment, right? So that is what, oops, almost erased it all, right? That's what equilibrium looks like in a closed economy, right? Go back to chapter 4, and that's what you're going to see. Equilibrium happens where the lines cross. Got to be true, right? No trade, no exports, no imports. Exports, current account is zero because current account is equal to net exports. If current account's equal to zero, it means investment equals saving. Okay. So is that true in the open economy? You know the answer from that, given how I'm saying it, right? So what's true in the open economy? If there was no trade in the closed economy, what does it mean to be open?
There is trade.
Trading.
Yeah, it's an open economy. You're open to other countries, trading with other countries, right? So the words, you can figure things out oftentimes just from the words, just the way closed economy. Yeah, think about there'd be a border around the U.S. like nothing comes in or nothing comes, not just like not just like the border wall that we hear about in the news, but no, I mean, like say it was all closed off, means we are just our own country ourselves, right? Open economy means we're open to trade with other countries, right? So there's trade. Current account could be zero. Exports could equal imports, but then it doesn't have to be necessarily, right? So we have exports, we have imports. What does equilibrium look like in the open economy? Is it where the lines cross? Could be, but not necessarily. Okay. Right? In the open economy, we have two graphs. Right? I'm going to draw it this way so that that one where they cross is higher than where this one crosses. So let's say this is the home country, the US, let's say. And we're looking outward to other countries. So this is the rest of the world. ROW, rest of world. Just think about the rest of the world as one big country. That's our simplification. That's our model, right? Because we'd have like 100 graphs otherwise, right? It would be too much. So in each one of these, right, there's desired investment in the home country, desired saving in the home country, desired saving in the foreign country, an F there, desired investment in the foreign country. So the question is, where's equilibrium going to happen? So what does equilibrium mean in the open economy and the goods market? So equilibrium in the open economy. Well, first of all, what was true for the closed economy? What's true in equilibrium up here in this yellow part up here, right up here?
Is it that real interest rate equals investment and savings?
Well, the real interest rate at that real interest rate, investment equals savings, but the real interest rate isn't equal to them. It just means if if R0 is the real interest rate, then there's no surplus, there's no shortage. It's where the lines cross. Saving equals investment, right? This thing that we have down here. So saving, so in that case, it's just one country, right? Saving in the country equals investment in that country. So what's the analog for the open economy? Saving in the world equals, equals investment in the world, or desired investment in the world. Well, what's saving in the world? Well, that's desired saving in the home country plus desired saving in the foreign country, right? What is investment in the world? Well, that's desired investment in the home country plus desired investment, in the foreign country. Now we're just going to do a little bit of algebra magic again, right? Let's bring all the home country stuff over to one side and all the foreign country stuff over to the other side. So let's bring this over here. Let's bring this over here. Right? Well, how do we do that? So first of all, subtract IH from both sides, right? So now we have desired saving in the home country minus desired investment in the home country. Over here, the eyes just cancel out, right? So that goes away. Now let's subtract foreign saving from both countries. That's going to go away. Minus, so this is going to be IDF from up here, minus desired saving in the foreign country. All right, so what is the current account? It's saving minus investment, right? That's what you told me? Or? So saving minus investment. This is the current account in the home country. This is what? This is over on the right-hand side. This is minus, if I bring that outside, then it's desired saving in the foreign country minus desired investment in the foreign country. I'm just rewriting this. But this is what? Minus CA in the foreign country. So in equilibrium, the current account of one, it's so equilibrium R, equilibrium world interest rate happens where this is true. Well, what does that look like? And then I'm gonna do this, and then we'll talk a little bit about chapter 7, and then we're gonna get to questions. Right? So I'm gonna redraw the graph I had up above. Right. So this is desired investment in the home country. This is desired saving in the home country. Real interest rate, investment and saving. This is the home country. This is the foreign country, or well, just call it rest of the world. It can be foreign countries, either way. Same thing. And I'm going to draw this so that the lines cross further down. Doesn't have to be that way. It doesn't really matter. But it's going to generally be more realistic to what's actually happened in the United States. So how do we find equilibrium? There's that equilibrium condition right up above, right? It's right there. So we're going to try and find we're finding the real interest rate such that this equals this, or that this equals this, but the opposite, right? I minus S versus S minus I. So that's the question. That's our quest. What interest rate is that going to, where is that going to occur at? So let's just pick some starting points so we don't have to start like anywhere, just anywhere, right? So if this was a closed economy, right, this would be the interest rate in the home country. R0. I don't know, it's 5%, let's say. Over here, right, it's lower on the vertical axis. Let's say it's 2%. Right? That would be the equilibrium in the rest of the world or foreign country, right? Let's just draw these lines all the way across. So those are kind of our boundaries. Well, why is that? So if the interest rate was 2%, saving and investment are just equal in the foreign country, the rest of the world. Over here, there's way more desired investment than there is saving available from the saving curve. There's excess demand. So firms want this much, want to borrow money to buy new capital, new machines, new machinery, industrial robots, warehouses, factories, etc. But there's only this much saving to borrow in that country at that interest rate, 2%. So there's a shortage of saving. In the other country, they're equal, right? No shortage or surplus there. So for the whole world economy, so we want to do this. Let's say this is 100. Let's say this is, I don't know, let's say this is 30. And this is, I don't know, 80. I'm just picking numbers, right? So saving minus investment, right? Investment's higher than saving. So this would be like 80. This would be 30. This would be minus 50, right? 30 minus 80. So the current account is negative. Current account is exports minus imports. So that means there's more imports than there are exports. We're running a trade deficit. But this, right, the current account over here all right? Imports and exports, each one of those is 100, 100, 100. That's 0, all right? Can that be the equilibrium interest rate? No. No. These have to be equal to be in equilibrium. So what's going to happen? There's excess demand in the home country for borrowing by firms for new capital, not enough saving available. Think about this being in the money in the bank, right? To finance the new capital. What's going to happen? Interest rate's going to go up. How far? Is it going to go up? Is it going to go up past 5%? No, because we have the opposite there, right? There's excess, there's a surplus of saving, more saving than investment in the home country at 5%. This is just an equilibrium. There's a surplus, so it's got to be lower because interest rates would come down then. So somewhere in between there is equilibrium. What is equilibrium? The equilibrium is where the difference between this line and that line is equal to the difference between that line and that line. That's what it means. That's investment and saving, investment and saving. Okay. So where does that happen? We have to kind of eyeball that. So let's pick a different color. Let's pick pink. If I'd eyeball that, it's maybe, it just happens to be pretty close to right in between. It's because the way it doesn't, you have to figure, you just have to eyeball it, right? So what we're saying is that at this interest rate, it's called R star world. Difference between here and here, it's called A and B. It's got to be equal to the difference between those two lines over here, C and D. Why is that? Here's the level of investment. Here's the level of desired saving. There's that distance. That distance right here is that. That's the current account. That distance is the current account. It's negative since investment bigger than saving. So this is the current account in the home country. It's got to be equal to that difference between saving and investment in the foreign country. So there's the level, whoops, I didn't draw that very clearly. Saving and investment, that distance. So we're saying in equilibrium for this problem, the distance AB has to be equal to the difference, distance CD, right? If the interest rate was any higher or lower, right, we could do it here. That wouldn't be true, right? That distance is not equal to that distance. So it's R star W. That's what equilibrium means. Now, if any of those curves shift, it's going to upset this equilibrium, this balance, and we got to find the new equilibrium. Okay, we'll get to that in the questions, I'm sure. Let's talk about chapter 7 for a minute. So that's chapter 5. Chapter 7. Money. First of all right? Uses of money. So, definition of money. Or no, well, it is uses, but let me say it is, because this is the way to actually talk about it. Functions of money. Asset portfolio. Let's just call it, well, decisions. Asset market equilibrium. Demand for money. Money and inflation. I encourage you to go in the table of contents and kind of write this out yourself. So chapter 7 is what? Is the asset market. What's an asset? just definitionally.
Something that gains value over time or something that appreciates.
Doesn't have to. Asset might depreciate. Assets can go up or down in value. But you're close, right? You're
Something
close.
that can gain money.
It can. It's even simpler. Go simpler. You're thinking too hard. You're thinking too hard.
Something of value.
Something what?
Something of value.
There you go. Boom. Now, that's it. Like, that's it. It's as simple as that, right? So something that has value. What things have value? Lots of things have value. The question is, how do we hold our wealth? Right? How do we hold it? So our wealth is our assets minus our liabilities. So, you know, liabilities be your loans that you have, right? Assets are anything of value that you have. You have a car, that's an asset. You got a bank account, that's an asset. You got cryptocurrency, that's an asset. You have a card collection, that's an asset. Comic book collection, it's an asset. You got artwork, that's an asset. Things that could be sold to get money. Money, currency, right? You have currency or coins, those are assets. They have value, right? What does that mean? What does it mean to have value? It means it can be used to purchase other things, to get other things. More or less easily, right? And so part of the decision about how to hold your wealth, right, has to do with things like risk, expected return, liquidity. How easy is it to turn it back into money that you can buy stuff with or pay the rent with? Right? Money is the most liquid asset because it is like you can use money directly to buy stuff, right? There are other things as well, right? Length of period, right? Length, time to maturity. If you're holding a CD in a bank, right? You might have to wait to cash it in, or if anybody has savings bonds, like really old school there. Right? And there are other things. There are other characteristics of assets that matter for how you decide which assets to hold. So generally, there's some portfolio, some collection of assets that you hold. So people, you, your parents, your grandparents, your cousins, whoever, they've got stuff of value. Could be, part of their wealth might be tied up in a car or cars, might be a house, might be, I own a nice bike, let's say, or motorcycle. Could be, I own some artwork, or if you're really fancy and like hip, you have non-fungible tokens, NFTs, all right? Maybe you have cryptocurrency, maybe you have stocks, bonds, right? Maybe you have a retirement account, ultimately, right? When you're working, some of you are. Savings accounts, checking accounts, those are all types of assets, and people hold some of all of those things oftentimes, right? So the question is, how much do you hold of each type of asset? That's our asset market portfolio decision. And it depends on the risk, the expected return, right? If you don't think the stock market's going to keep going up, maybe you sell, get out of stock, maybe you put money in the bank for a while, and buy stocks later, or maybe you buy real estate, right? So there are all sorts of assets that have different kinds of characteristics to them, right? Maybe you buy housing, either to live in or as an asset, right? To try and buy low, sell high, right? But that's risky, right? So there's a trade-off oftentimes between risk and return, right? Expected return, because you don't know what the return is going to be for sure. But the higher, in general, the higher the risk of what? The risk of default, the risk that the asset that you own goes bust, right? And doesn't worth anything, right? And like you could have a house, right? And this goes a little further afield, but you know, if you're into finance and you take money in banking class, for example, you learn about something about insurance or in finance area, right? Why do people buy insurance? Because it's to mitigate risk, right? Because your house could burn down, like it's worth nothing if you don't, or a flood, right? Hurricane, right? Florida. Only a fraction of the houses that were destroyed Hurricane Ian are insured. Less than half, right? They're just gone, just a loss. You just lost it, right? So people holding those summer vacation homes, right? Let's say, all right, beach houses. So what we're ultimately interested in this chapter, though, right, is money. Whoa, money. Why? This is we're just going to go a little bit further on this, and then we're going to come back and answer questions. Why money?
Makes the world go round.
Yeah, in a macroeconomics course, why do we focus on money? I mean, that's true. But
A country's wealth, like their GDP or whatever.
how so? Doesn't
Um,
have to. We don't have to. We could barter. We could just trade goods and services.
But isn't that a way of measuring a country's wealth?
That's
Based on a
so if we go back to definitions, functions of money, sorry, but that is related to the definition too. But what function of money is that you're talking about right now? Money as what? Unit
not
of
a
account.
median.
No, a unit of
Oh,
account.
a unit of measure. A
Unit
unit
of
of
measure.
account.
Yeah. So in the United States, we use dollars. If you were in Germany, you'd use euros. If you were in England, you'd use pounds. If you were in Japan, you'd use yen, right? So that's how we measure. That's right. GDP, for example. That's right. Right. That's one way we measure it. What are the other functions of money? What do we use money for? We use it to measure values of things, right? That's the unit of account. What else do we use money for? This is gonna be related to why we care about money, right? Because ultimately the chapter is about money, a very particular asset. So what are the other functions of money?
As a medium of exchange.
All right, a medium of exchange. What does that mean?
You use money to purchase other goods.
Yep, we use money to buy other stuff, to buy stuff, right? And if we were physically in class together right now, I'd pull out whatever money I had in my wallet, if I had any money in my wallet, or no, currency, I should say. I'd pull out currency, and I'd read the back of it, and anybody know what it says on the back? Anybody pulling out like a dollar bill, 10, 20, 50, doesn't matter. Anybody know what it says on the back?
U.S. Treasury or something.
It does. Well, that says that too. Yeah. Yes. What about that? It says this note is legal tender for all debts, public and private. All right. It's stamped on the currency. What else does it say? Interestingly, it says in God we trust. It's very interesting. Take a look at your currency sometime. And you can actually Google that and how that came to be on our currency. It wasn't always on the currency. So that medium of exchange matters. That's related to definitions of money, which goes to why we care about this chapter. So what is money?
Fiat, paper.
Yeah, paper currency. So currency is included. That's this note is legal tender for all debts, public and private, written on dollar bills, 5, 10, 20, paper currency, right? That's fiat by decree. That's what it means, by decree. Why is it a value? Because the government says it has value. That's why. It's written right on there, right? So currency and coins. What else? That's not the most important kind of money in the economy, but it is part of money.
We're talking like accounts,
Like a what? Sorry.
like banking accounts of some
Yeah,
sort.
yeah. So checking accounts, savings accounts, money market mutual funds, certificates of deposit. These are all parts of what? M2. We have M2, we got M1 too. We have M1. M1 is just really primarily, M1 is primarily currency and checking accounts. Also, traveler's checks. M2 includes M1 plus these other things. So how is this related to the functions of money? Right, money, a third one, right, is a store of value, right? That is, we can hang on to money for use in the future. Like savings accounts, checking accounts, right? Save money, put it in the bank. We can get it out later. Buy something. So what do all these things have to do with? What function of money do they have to do with? Medium of exchange. We use money to buy stuff, right? The more, and so money is tied to buying stuff. Buying stuff is related to production of stuff. Buying stuff's related to GDP, right? Remember back in chapter 2, we talked about 3 different ways you can measure GDP. You can measure GDP by the value of all the production. You can measure it by incomes generated in that production. Or you can measure it by what? A little review, right? We can measure it by production. We can measure it by income. We can measure it by spending. This is going to turn out to be a really big deal when we get to chapter 9. Really big deal, right? And when we measure GDP, C plus I plus G plus net exports. So M1 and M2 in particular, the amount of money, right? People need money to buy stuff. So that's where the demand for money comes from, to buy stuff, but also as a store of money, also to hold on to it. But you need money to buy stuff. So consumption is directly related to spending, is directly related to how much money there is in the economy. So M1 and M2 are the money supply. Who controls the money supply in the economy?
The
The
Federal
reserve,
Federal Reserve. They're in the paper, almost in the news almost every day. All right, these days. Great time to be taking macroeconomics. Federal Reserve controls the money supply. Now, back in the day, they actually do it a little bit differently. Textbook hasn't sort of caught up to this. It's kind of interesting because your textbook author, one of the two textbook authors, Ben Bernanke, was actually the head of the Federal Reserve. And so the discussion about how the Federal Reserve carries out its a monetary policy, and that's not really in a different chapter later, as it says in chapter 7. That's not, I want to go off on a tangent here, but later on in a different chapter they do talk about that. Money and banking, we talk a lot more about that in money and banking class, Econ 315. Learn about it in Econ 201 as well. But the sort of broad idea and the way they used to really do it, they do it a bit differently now, but they control, well, yeah, I'll say by controlling the money supply, they control the interest rates. So the Federal Reserve controls the interest rates, and well, they control the federal funds rate, a really short-term rate. But they control interest rates in the economy. So what's this called? Monetary policy. That's what's in the news every week, every month. They meet every 6 weeks to make a decision about where to set the interest rate. And they use the monetary policy to do that. So it's important for us to know about money. So the nice thing about this chapter is that we can talk about the decisions that people make about assets, right? About how much money to hold and about how much to hold their wealth in non-monetary assets. But when we find equilibrium in the market for non-monetary assets, that's one of the sections in the book, equilibrium in the asset market, right? In chapter 7, if you find, and the importance of that section to say, if you find equilibrium in the market for non-monetary assets like stocks, bonds, etc., then you can show that you found the equilibrium in the money market. So we don't need to focus on all the different assets. We can only focus on one, money. That's important because we're going to talk about money demand, money supply. If you watch the video, that diagram is actually not in this chapter. It will be in chapter 9, but I introduce it to you. The real interest rate. Here's the real money supply. Here's money demand, real money supply. And the real money demand is a function of the real interest rate, but also GDP, since more spending, more income, more spending, more demand for money to buy stuff. Just together, those determine the interest rate. And if you change the money supply, reduce the money supply, for example, then what's going to happen? Equilibrium is going to be at a different interest rate. So by changing the money supply, monetary policy, decreasing or increasing the money supply, right? The Federal Reserve can change the real interest rate. So in chapter 9, we're going to see why this is important. This is exactly what's in the news right now. Federal Reserve is raising interest rates. They're going to raise interest rates when they meet again in the next couple of weeks, right? To do what? To slow down spending in the economy. raise the interest rate, which then is going to slow down spending. That's the hope by firms and by consumers. And the last part of this chapter is talking about the amount of money, money and inflation. And I'm just going to point you to the homework and the solutions to the last homework, where actually I have discussion about that. Okay. So that was question number 3 on the homework that you just handed in at the end of last week. So we're going to see how this plays, how the importance of this is building up to chapter 9, but chapter 7 is really all about money. Money is important for the economy, not just because it makes the economy go. That is one that is important, but for us in macroeconomics, because the amount of money that's in the economy affects inflation, it affects spending, and it affects, as we're going to see, real GDP in the short run, but certainly affects inflation in the long run. We have to wait till chapter 9 to have that whole thing, but we have a lot of it here already. Okay, so I'm gonna kind of clean the slate here, and I'm going to turn this back to all of you in terms of questions, because I've been talking long enough. So, Brittany had sent me emails earlier today. I answered one, was able to get back to one of them because of meetings and meetings with students and meetings that we have every Monday as chairs. So I'm gonna let her go first because I didn't get to all of hers that she emailed me about. So pick one of them, Brittany, that you have, and then we'll go from there.
So this is not my main question, but I'm gonna do this one first because it kind of relates to is money. Question 11 of the review questions, part C. The very end of that question asks, why would the Federal Reserve care about trying to determine the overall demand for money,
Right.
for real money balances in the economy? Other
Right.
than to promote a strong economy, what is there really to say about that?
Yeah, so no, it's more technical than that. But I get it. I saw this was one of your emails earlier. I just wasn't able to get back to you about it beforehand. So here's the real money supply. So if we think about this, and again, this graph, it's in the video for the chapter that the demonstration video, but this graph is actually not in the chapter. It's implicit in there, and you'll see it in chapter 9. But right, so the idea here, right, price level is given, right? We're going to see how that matters when we get into chapter 9. The Federal Reserve controls this. And if the price level is not changing, then they control the real money supply. And because of that, right, if they know that this L in chapter 7, right, it's like a function of, it just stands for liquidity, right? Because money demand is the demand for liquidity. Demand for liquidity for buying stuff, right? Because you got to use money. Even if you use credit card to buy stuff, at the end of the day, you got to have money balances in your account to pay for your credit card bill at the end of the month. So credit cards are not money, right? It's the balances, the bank balances that are behind those credit cards that are money, all right? So, so this is a function of real interest rate and real GDP, right? So real GDP has to do with spending, and that's related to the more spending, the more money demand. So if the Federal Reserve knows that the money demand curve looks like this, not like that, but like that, then it knows the interest rate's going to be right there, right? What if money demand, for some reason, what if money demand increased? Shifted to the right. I don't know, for some reason, for whatever reason. If the Federal Reserve didn't do anything, what would happen to the real interest rate? Go up, right? Where lines cross, right? Equilibrium would be there. Let's call it M1, right? M0. But they don't want them. But they don't want the interest rate there, right? They want let's say they want the interest rate to stay at R0. right? They get to choose the interest rate. They get to set the interest rate. So if they wanted to do that, what would they have to do to get the interest rate back to R0? If they control the money supply. Well, they want the money supply line to cross here, right? Right. They'd have to increase the money supply. Well, prime, right? Or MS prime is greater than MS, right? In that case, they could get, so they can change the money supply using open market operations. We're not going to go into detail about that. All you got to do is go with me on this. We can do that. That's not part of what we're doing here, right? The Federal Reserve can make the money supply whatever it wants. They buy and sell government securities to do that. They can do it as much as they want. It's just it's actually a digital transaction, right? So, but they don't just do it however much, because if they do too much, then there's going to be too much money in the economy, and it's going to lead to inflation, which is why we're in this, part of the reason we're in the situation we're in right now in the economy. They kept interest rates really low. They kept pushing the money supply out, right? To get interest rates really low, right? To deal with COVID, to deal with the pandemic, right? To keep spending going, right? Low interest rates, more house buying, more investment in new equipment, et cetera, right? Because interest rates are really low, right? So it's important for the Federal Reserve to know where the money demand is, because they need to set the money supply accordingly to keep interest rates where they want to keep them. If the Federal Reserve did not know what was happening to money demand, they would keep money supply right here, and interest rates would go up. If interest rates go up, that's going to slow down the economy unexpectedly. So back in the day, at one point, they would really spend a lot of time trying to figure out, well, to try and estimate, well, what's happening to money demand? Is it increase? If it's increasing, then we got to increase the money supply to go along with it to keep interest rates where they are. If it's not changing, we can keep money supply where it is. But that's what monetary policy is all about. So that's the answer to that question.
Thank you.
Other questions?
Hi, can you show how to set up for how to calculate the user cost of capital and determine the optimal size of capital stock?
Mhm.
It's
The
from
user-
the exam
So
preparation.
the user cost is what? R plus
Mm.
D, where R is the real interest rate, D is the depreciation rate times the price of capital.
Mhm.
So you got to have that
Okay.
information to be able to tell that. And then equilibrium happens where what's true, or the expected future marginal productivity of, whoops.
Of capital equals marginal product of N.
Equals the user cost. It's the marginal benefit of one more piece of capital. That's the marginal cost, right? Of one more unit of capital, one more machine, one more robot, whatever. One more square foot of warehouse space or factory space, right? So as long as the marginal benefit's greater than the marginal cost, then you keep doing more of it, right? So as long as the marginal expected future productivity of capital is greater than the user cost of capital, buy more capital. Stop when the user cost becomes greater than marginal productivity of capital. What does that mean in a picture? It means in a picture, right? Here's we know that that is downward sloping just because there's diminishing returns, comes from the production function. Here's the user cost of capital, R plus D times the price of capital, right? So this is the amount of capital. There's the expected marginal productivity of capital and the user cost of capital measured on the vertical axis, right? So would you, my hand resting on the screen on my iPad is not, Notability is not like that sometimes. Would you, come on, what's going on here? Would you buy the first unit of capital? Yeah, because the marginal productivity of capital is up here, the user cost is down here. Right? Yep. Would you go to a second one? Yep. Would you go to a third one? Yep. All right, just moving down that productivity. Would you go to a fourth one? No, because the user cost is here. The expected future marginal productivity is there, right? So, it's not worthwhile. You'd stop at 3 in that case. So 3 would be your K star in that case. In other words, the optimal amount of capital. So I think the question that you have actually has numbers to it. And it's just a matter of comparing those numbers for each K, right? For each K, as long as the expected future marginal productivity is greater than the user cost, then you keep going. When that becomes lower, then you go stop or go back 1. Does that work?
Yes, thank you.
Okay. Okay. Next, other questions. What's your
So-
other, what's the third question that you had, Brittany? Yeah.
Oh, I have
today.
many questions, but my main one for this session was gonna be, can we walk through number 1 of the review questions? It kind of covers everything chapter 5, and I think that's really where I'm struggling.
All right, so let me actually I'm working on my laptop, so I don't have they're layered on top of each other. So oh, sorry, I have, yeah, not the review questions, but which one? Sorry, what did you say? The review
The-
questions or the past exam questions?
The first review question, or well, I mean, isn't that the same thing?
No, there's another document with review questions in it.
Huh, oh, I overlooked that. I'm talking about the past exam.
Yeah, they're both in the same area in Blackboard. So they're both under, so it's, in fact, it's right above it, right? And resources to help you prepare for exams. So exam preparation, right? Review questions for exams by chapter, that's there. And then exam questions from previous semesters is right below that. So let's bring that up. So make sure I get the right one here. Oh, the first about the budget deficit rising. Is that the question, Brittany?
Sorry, I was on my other screen, so it wouldn't unmute me.
Yeah.
Yes, that question about the budget deficit.
Okay, so for everybody, that's here. All right, and doesn't have this up. All right, according to recent reports, federal government budget deficit rose to $1 trillion this year. See, Congressional Budget Office projections show that the federal budget deficit persisting and then increasing over the next decade, whether measured in actual spending or as a percentage of GDP. Right, that's actually a true statement. I mean, I could make that. I could make that one up too, but I mean, right, try and do things that are real. All right. According to the uses of saving identity, what are the possible outcomes of these projected increases in federal budget deficits? How could they lead to a slowdown in economic growth over the next decade? We had that question in the last exam. All right, we had that question in the last exam. Because I could ask that in chapter 2. I could ask it in chapter 4. I could ask it in chapter 5. Right? Because it all goes to the uses of saving that. And it says, according to the goods market, what are the outcomes of these projected increases in federal budget deficits? Going back to the use of saving identity, how might the projected increase in budget deficits affect national wealth? Right. Investments are smaller. An open economy model, the closed economy model, the goods market. Oh, so there's actually a piece of that that's missing when I cut and paste. It looks like part of that did not get cut. But it's trying to say that the impacts show that the impacts on investment are smaller in an open economy model than in a closed economy model. So let's just work through that. So, okay. Now, oops. All right. So we have the uses of saving identity, all right? Right. So if it was a closed economy, let's just do that first. Well, first of all, if there are increased budget deficits, what does that mean in terms of the uses of saving identity? Like we literally had this question in the first exam and on multiple homeworks now, actually. So budget deficit increases. Like this is the kind of thinking that I need to be able to do, right? That I need to start to be able to really do quickly. Budget deficit increases, something happens, right? That's the stem of the problem. That's the stem of the question. Translating that into just like, okay, this is what happens. What happens in the uses of saving identity? Like you don't have to know which market because I'm telling you the goods market, but you know, so something happens, which market, which curve, which way. But in this case, let's think about the equation. Budget deficit increase, how does it affect, where does it show up in this equation? And we got to know this first. Does it affect S, I, or CA?
I.
So what's the budget deficit?
So savings.
Saving by the government, right? Go back to chapter 2, all right? It's tax revenue minus interest payment on the debt, minus transfers, right? Minus government savings. This is tax revenue, right? Like that's the budget deficit. That's the budget surplus, actually. The budget deficit is minus saving by the government. Right. So that's a really fundamental thing. That's a really fundamental thing. You got to just know that. You got to know that without like thinking about it. All right, we've had lots and lots of practice with that one, actually. So budget deficit, saving by the government goes down, right? Psh, that goes down, right? There's an equal sign here. If that goes down, or that goes down. It's the only way it can be. There's an equal sign there, right? So what are the question is like, what are the likely outcomes of that? Well, if investment goes down, right, then there's not going to be as much capital, right? That is going to, right, that affects the production function. Right? Not as much capital, right? So not that capital is going to go down. There's going to be as much capital in the future as there would have been. Capital's in the production function. So economic growth is not going to be as big as it would have been. We learned that back in chapter 6 too. So we had chapter 2, we had chapter 6, right? Chapter 3, kind of all related to all those. Current account goes down. What does that mean? So if we already have a trade deficit, that means that's negative. So CA in the US for the US, I mean in the real world, right? For the US, CA becomes more negative. In other words, our trade deficit increases. Now, one of the things so this could mean lower growth in the future. What about this? All right, CA goes down. Well, from chapter 5, we know that the current account plus the financial account equals 0. So this is, I mean, we can talk through it in words, or we can talk through it in terms of what we learned in chapter 5. So the current account has to do with goods and services, goods and services. Right. Services. There we go. The financial account. So this is dollar flows in and out of the country to buy goods and services, exports, imports, right? This is about exports and imports. What's the financial account? So those are dollar flows, not for goods and services, related to the sale and purchase of assets, real and financial. Well, we know from chapter 7, but we already know something about this. Assets are things that have value. Real assets are things like factories, houses, land, real estate. Financial assets, stocks, bonds, etc. So if the current account's going down because of budget deficit, by the way, bigger budget deficit, bigger trade deficit, twin deficits, that was on homework 5. I really, 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 really encourage you to look at the solutions to homework 4 and 5 that are posted in Blackboard. Those are study tools as well. Okay. So if this is going down, it means the financial, if the two of them together are equal to 0, it means if one's going down, the other one's got to be going up. What does it mean for this to be going up? So if the current account's going down, it means more dollars are going out of the country than coming in. So the opposite would mean for the financial account means more dollars are coming in than are going out. If dollars are coming in, what are they coming in from? From selling financial assets. Like what? Like treasury bonds by the government, right? So trade deficit means, right, going down means that the current account going down means bigger trade deficit. What does that mean? It means we're importing more than we're exporting. More dollars are going into other countries' hands than are coming back to buy our goods and services. What do they do with those dollars? Now I'm just going to talk it through in that financial account in terms of words, right? Dollars are building up in other countries. They don't want dollars. They have to pay workers in yen or in euros or whatever. So what do? They buy assets in the United States. They buy real estate. They buy companies. They buy stocks. They buy bonds. One of the things they do is they buy U.S. Treasury bonds. Where do the Treasury bonds come from? When the government runs a budget deficit, it prints bonds. That's what it does. Right? It prints pieces of paper, U.S. Treasury bonds, and sells them on the open market to pay for budget deficit. Right? Whatever they mean, if they're running a budget deficit, it means our taxes were not big enough to pay for all our expenses. We got to borrow money. Borrowing money for the government means printing government treasury bonds. Who can buy them? Anybody can buy them, right? So people in other countries buy them. Because why? Because because the U.S. is not going to default on its bonds. They offer a return on money, right? And so when we run a trade deficit, what we're saying, or when we run a budget deficit, we print more bonds. What we're saying is financial account goes up, means other countries hold more of our bonds. we run a bigger trade deficit, we run a bigger trade surplus or a financial account surplus. More money's coming in than going out. That means we're selling bonds or real estate or something to get that money. How does that affect our wealth? I'm kind of going through those questions that are there. They may not be exactly in the same order. That means other countries have a the word I'm looking for. Have a hold on, not a hold. They have a. We owe them, right? So they have, they can turn in those government bonds and want to get payment, right? So you say, well, that's a bad thing, right? So in our wealth may be going down, right? We're selling off assets, right? You say, well, that's not good. Well, it depends, right? It depends what we do with the money that we borrowed. So if the government is running a budget deficit in order to put more roads and bridges and ports and more internet broadband access, then that's going to increase the economy in the long run. And we can pay off our debt and be better off. In the same way that you take out money for school loans, go into debt, it reduces your wealth, right? You have more liabilities. Your personal wealth is lower. Why do you do it? Because you're going to invest in yourself, in your human capital. And by doing that, you get a degree, you get higher income, you can pay off your student loan and still be ahead of where you would have been had you not borrowed the money and come to school. It's the same exact thing. So back to this, I'm not just back to this, but let's go back to the specifics, right? So government budget deficit goes down, means saving goes down, right? So what could happen with that, right? Well, investment could go down, the current account could go down, or both, right? But it's possible that, right? And so that has, especially if investment goes down, that has negative consequences for the economy. We learned about that in terms of economic growth. So, in fact, if this goes down enough, then like this wouldn't even that could offset the decline in savings. And so if enough, what does that mean? It means if enough foreigners buy our debt, then it doesn't affect investment in the United States. Why would it affect investment? Because otherwise interest rates are going to go up from the government borrowing money. So let's look at that. That's really the deal here. That's what we want to focus on. First of all, closed economy. Oops. Yes. If government budget goes up, budget deficit goes up, what happens? We said saving goes down, right? What's going to happen? Real interest rate goes up. Because of that, that increases the user cost of capital, less capital, and there's less, right? There's used to be here, now it's here, right? So it's gone down. It used to be there. Now there's less investment, right? Measured on that axis, right? It's gone down. Used to be 100, now it's 80. That's the closed economy case. So investment went down. Remember, we set up there saving equals investment plus the current account. But in the closed economy, there's no current account. Zero. So anything that happens here has to happen there. That's what that graph is showing. What about the open economy? Open economy. Again, let me draw it like I drew the other one where it's higher real interest rate where the lines cross. It's desired saving, desired investment, desired saving, desired investment. This is the foreign country, home country. where does equilibrium occur? Remember, we got to find the R where the difference between saving and investment in the home country is equal to opposite saving investment in the other countries. So you have to kind of eyeball that. Something like, oops. Something like maybe, no, I was a little too low there. I can see that already. Maybe. Right, the idea is that this distance and that distance have to be the same. Here is investment, saving in the home country. That difference there is the current account, the home country. It's less, it's negative. I could scroll back up to where we were at the beginning. Remember, the current account is equal to saving minus investment. Investment's bigger than saving, so it's going to be negative. Over here, here's the amount of saving. Here's the amount of investment in equilibrium. That is the current account in the foreign country, right? The difference between saving and investment. In this case, it's going to be saving is bigger than investment, so it's going to be positive, be greater than 0. So this distance right here has to equal that distance right there. Now, right, the question is, what happens if there's a decline in, right, just like up above, right? Let's say that there is a reduction in saving in the home country because there's a budget deficit. This is no longer the same equilibrium, right? This is the starting point, called R0. That's no longer the equilibrium, though. Why? Because the difference between saving and investment now is bigger here than it is on the other country. So what's going to happen? There's a bigger difference between investment and now saving is back here. That there's a shortage of saving for investment. So interest rate. So it's as if this line isn't even there anymore. The purple line is the one that's there. So now we got to play that same game, kind of eyeball it and say, you know what, that distance, I don't quite have it right here. It's not quite that, doesn't go up quite that much, but it goes up a little bit. The real world interest rate is going to go up. The level of saving has gone down here. The level of investment went down. The level of saving used to be here. Now it's gone down. They've both gone down. It's hard to tell what happened to the current account, right? But we can tell over here because the higher real interest rate, savings gone up, investment's gone down. We can see that this distance is bigger than that distance, and that's the current account. The current account surplus has gotten bigger over here, so the deficit had to have gotten bigger over here. This purple distance is bigger than that blue distance, right? So what's happened? Saving has gone down. I knew that. Investment's gone down. And the current account has gone down. So now in the open economy, what's happened? Saving went down. Investment went down. And the current account went down. So if saving went down by 100, in the closed economy, investment would have gone down by 100. In the open economy, though, this might be 60 and 40. Right? It's split between the current account and investment. So before, much bigger impact on investment. In the open economy, less of an impact on investment. Why? Because foreigners are buying. We don't need to rely just on saving in the United States like we do in this case. In the open economy, we can rely on saving also in the foreign country. They're buying some of our debt. More savings available, so that impact on interest rates not as big. So those trade deficits actually help us in that case. So there's why? Because they're sucking up some of our debt, right? The interest rate doesn't go up as much as it would have to if we were just relying on saving in our own country. And as a consequence, investment doesn't go down as much. Remember up here, we said, ooh, that's not good, right? And so there's less of a negative impact on the US economy in that case. Smaller impact of a budget deficit when the economy is open than when it's closed. And so, Brittany, you should be saying about now that looks like other questions we've had, including questions 1 and 2 on the homework number 5 that we just did. And the answer is yes, absolutely, that's correct. There are only so many questions I can ask. There just aren't that many. There just aren't that many. There aren't a lot of questions I can ask. There aren't that many questions I can ask on this exam.
And in this review session, this all makes perfect sense. And then I get to looking at the questions and none of it makes sense. So yeah. I just need to keep looking at it. Thank you though.
Yeah, so I think, but one of the things about that is so you're going to see some of those questions from past exams, you're going to see variations on a theme, right? Some of them are going to be very similar, but they might be worded, there might be some slight differences, right? But one of the big, so also the whole twin deficit issue, right? So in this case, government budget deficit went up, so did the trade deficit. That's another thing that's talked about in the chapter. That's another thing that comes up in the news. So should we have been surprised when, in the homework question, right, during the Trump administration, the argument was going to be, I'm going to put tariffs, we're putting tariffs on foreign goods. That's going to reduce our trade deficit. But at the same time, we had big tax cuts too. And so we saw is that, like, even though there were tariffs that made foreign goods more expensive to get into the US and were intended to harm China, other countries, China in particular, that our trade deficit got bigger. It's like, what? Well, no, this model, that's exactly what the model would predict. It's exactly what economists would predict from that. So again, trade deficits, budget deficits, saving. Okay, so chapters 4 and 5, in terms of the model, it's the same thing. It's a goods market. There are only two things. There are only two curves: saving and investment. They shift to the right or they shift to the left. And you can, in chapter 4, it tells you all the things that shift the curve to the right or to the left. So in the closed economy, it's just a matter in that case of right, one graph, right, one graph here. Simple now, right? And the closed economy, that the difference is now we have two graphs, and the equilibrium is a little different. So what can you expect to see on the exam in that regard? You're going to see what you should be really practiced in, really expecting at this point, right? Because we've done it over and over and over again in the course on homeworks, for example, on exam questions, right? Is we start in equilibrium, something happens, some curve shifts, and it changes the equilibrium. And then putting that into words. What does that mean? You're going to have to do that. That's what we do. That's what you're going to do in chapter 9. So we're going to do on exam 3. You're going to do exactly the same thing. It's just the nature of things change. Exam 3 in chapter 9 is going to bring all of these markets together. So that's the part that just adds a little more both complexity and realism to the model. We have the whole model at this point. We've got everything we need. In fact, we had that in chapter 4. And well, now 7 too, but yeah. So next week we'll spend 2 weeks on chapter 9 because it's a big one. It's a big thing. It's a big deal. And we'll get lots of practice with that, and I'll have a homework on chapter 9. And but it's going to be shifting curves, but it's not just shifting curves, it's translating things from the real world into our model, which is ultimately leads to shifting curves. And then how do these models, they're tools, they're just tools for us, right? They simplify the world, because otherwise it would be too complex, right? We wouldn't be able to. If I asked you, well, what happens if we have a budget deficit? What's going to happen to the real interest rate? What's going to happen to the price flow? What's going to happen to employment? What's going to happen to GDP? What's going to happen to saving and investment? And I will ask you that. That'll be a question. That'll be exactly the kind of question you'll get in chapter 9, right? From one problem. Here, it's still simpler. What happens to saving and investment, trade deficit, budget deficit, or in this case, I'm sorry, trade deficit, current account. So that's the way you want to think about studying for this. How can I translate that into these pictures? And when you do that, really, it's a multiple choice question. Things that you're going to get, either shift saving to the right or left, investment to the right or to the left. 4 options. Even if you're guessing, you got 25% chance of being right? Then, but you have to work it through, and you got to explain the why, right? The why and what happens, and how does that relate to the question? So if you can put everything in terms of that, if you can think about it that way, it will help you in terms of studying. So I'm kind of responding to Brittany's comment, like, well, when I look at the questions, and I don't know, like it seems clear when we're going through here, but then when I look at questions, it all seems different. But they're not. It's not. And that's what I'm trying to say, is that I need you to be able to translate it into that kind of framework. And so it doesn't seem like that. And if you've gotten to that point, then you know you've studied enough. So there are review questions in there. There are these questions from past exams. Will the questions on this exam look similar to those? Yeah, 100%. Yes, 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 yes. There are only so many ways I can ask the questions, right? There are going to be some variation on those themes. And the review questions that are there too. You have the homework 4 and homework 5 questions, right? And there you actually have the solutions, right? You have my solutions. They're in Blackboard. They're right there. Make use of that. And then you've got the videos, etc. too. But the assumption is that you've done all that already. If you haven't done that, then it might be useful to look at those as well. All right, we're past time, 7:55. Everybody's brain is, we're beyond diminishing returns at this point, I'm sure. So. All right, so good luck tomorrow. And just don't make it harder than it needs to be. That's my plea to you. All right. All right. We'll see everybody tomorrow night.
Bye.
Thank you.
Okay. Bye-bye.